Imagine turning $1,000 into a fortune without lifting a finger for the company. Sounds like magic? It's not, it's stocks. But how do they actually work? Stick around, because in the next 13 minutes, I'll break it down so simply, even your grandma will get it. Let's dive in. History of stocks. Back in the 1600s, the Dutch East India Company was like the Amazon of its time. They had hundreds of massive ships sailing around the world, trading gold, porcelain, spices, and silks from places like India and China. But here's the catch. Running this huge operation cost a fortune. Building ships, hiring crews, and dealing with pirates and storms, super expensive. So what did they do? They turned to everyday people, private citizens like merchants or even regular folks with some savings. These investors could put money into a voyage in exchange for a share of the profits when the ship returned, loaded with treasures. If the trip was a success, everyone won. The company made bank and the investors got a nice payout. This idea caught on fast. The company started selling these shares in coffee houses and busy shipping ports across Europe. And just like that, without even realizing it, they invented the world's first stock market. It was a game changer because it let companies raise big money from lots of people, funding even bigger adventures and bigger profits. Fast forward to today, and companies still do the same thing. They sell shares, now called stocks, to fund their growth. But the stock market has evolved into something way more complex, with apps on your phone, 24/7 news, and billions traded every day. Schools teach it, careers are built on it, and there are even TV channels obsessed with it. So how do modern companies and investors use this system? Let's break it down step by step. What are stocks and how do companies go public? Okay, first things first. What exactly is a stock? Think of it like owning a tiny slice of a company. If a business is like a giant pizza, a stock is one piece. When you buy it, you're not just giving them money. You become a partial owner. That means if the company does well, your slice gets more valuable, and you might even get a cut of the profits through something called dividends, which are like bonus payments. Now, how does a company start selling these stocks? Let's imagine a fun example. Say you and I start a coffee company called Brewmaster. We make amazing lattes, and business is booming in our local shop. But we want to expand, open more stores, buy fancy espresso machines, maybe even go national. We need cash, but we don't have millions lying around. So we decide to go public. That means launching on the stock market. First, we pitch our idea to big investors, like banks or wealthy funds. We show them our business plan. Hey, coffee is hot right now, pun intended. Invest in us. If they like it, they buy in early and help sponsor our initial public offering, or IPO. That's the big debut where we officially sell stocks to the public. During the IPO, we might sell millions of shares at, say, $10 each. Anyone who thinks Brewmaster could be the next Starbucks, companies, everyday people like you, can buy them. We're now a public company traded on exchanges like the New York Stock Exchange or NASDAQ. Why do this? Your investment helps us grow. We use the money to build those new stores, hire baristas, and market our killer cold brews. As owners, you get voting rights on big decisions, like who runs the company. And if we succeed, everyone benefits. But here's where it gets exciting and a bit risky. Coming up, I'll explain why stock prices go up and down like a roller coaster. If you're thinking about investing, this is the part you can't miss. How stock prices work. Supply and demand. All right, let's talk prices. Once stocks are out there, their value isn't fixed. It's all about supply and demand, like an auction at a flea market. Back to Brewmaster. Suppose after our IPO, people love our coffee. Sales skyrocket, we open 10 new shops, and influencers are posting about us. More buyers see the potential and want in. This company's going places, they say. Demand shoots up, so the stock price rises, maybe from $10 to $20. If you bought early, your shares are now worth double. Sweet. For the company, this is gold. Higher stock prices mean we're seen as valuable, making it easier to borrow money or attract talent. Our overall market value, what the whole company is worth on paper, jumps too. Now think of real companies. Take Apple. Back in the 1980s, their stock was cheap. But as iPhones exploded, demand surged and early investors became millionaires. Or Tesla. When electric cars got hot, their stock rocketed because people believed in the future. But what if things go south? Imagine Brewmaster hits a snag. Coffee bean prices spike due to bad weather, or a competitor launches a better app for ordering. Investors get nervous. Is this still a winner? They start selling shares to cash out before it drops more. As more people sell, supply floods the market, demand drops, and the price falls, say back to $5. You could lose money if you sell then. The company's value shrinks, making growth harder. In extreme cases like during the 2008 financial crisis, whole markets crash because fear spreads like wildfire. This up and down is driven by tons of factors. Hit that like button if this is clicking for you. Let's keep going. What influences the market? So why do prices swing? It's not random. It's a mix of real business stuff and human emotions. First, market forces. Companies deal with changing costs. For Brewmaster, if beans get pricier or new tech makes brewing faster, that affects profits. Labor costs rise if we pay baristas more. Good for workers, but it squeezes margins. Then, big picture stuff. Leadership changes, like if our CEO quits, can spook investors. Bad publicity, a viral video of a dirty store, tanks trust. Or external hits, new laws like taxes on sugary drinks or trade wars raising import costs. Even global events play in. Remember COVID? Travel stocks plummeted because no one flew, but Zoom soared as we all went remote. And don't forget psychology. Investors aren't robots. They're people. If a stock looks hot, everyone piles in, creating bubbles. But panic selling can cause crashes. It's why the market's noisy day to day. Pros try to predict this with tools like charts and AI, but it's unpredictable. That's why experts preach long-term investing over quick flips. Buy solid companies, hold for years, and let growth compound. Like Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. If you're hooked, subscribe now. We'll cover investing tips in future videos. Risks and tips for beginners. Stocks aren't a get-rich-quick scheme. You can lose money big time if you chase hype. But with smarts, they're a powerful way to build wealth. Start small. Use apps like Robinhood or Fidelity. Research companies you understand, like ones you use daily. Diversify. Don't put all eggs in one basket. And think long-term. History shows markets rise over time, despite dips. Remember, anyone can play. The internet democratized this. No need to be rich. Educate yourself, support businesses you believe in, and pursue your goals. So to wrap up, stocks started with spice ships but now power the world economy. Companies raise money through IPOs, prices fluctuate on supply and demand, and smart investing beats gambling. If this cleared up stocks for you, smash that like button, subscribe for more finance breakdowns, and comment below. What's your first stock pick? Share this with a friend who's clueless about investing. It might change their life. Thanks for watching. See you next time.